All right, welcome to Talk Tickers. Today, we're diving into the latest earnings from specialty insurer RLI Corp. And honestly, it's a bit of a head scratcher. You got this company that just posted a huge profit beat, totally blowing past what analysts expected. But the market's reaction? A shrug. So what is going on here? Let's get into it. So, right out of the gate, the headline number was just a stunner. RLI came in with operating earnings of 83 cents a share. I mean, that absolutely smashed the analyst's consensus by almost 34%. Numbers like that, they don't just beat expectations. They really make you sit up and pay attention. Okay, so here's how we're going to break this down. We'll start with a quick snapshot of the Q3 earnings, then we'll get into their secret sauce, which is really their underwriting story. After that, we'll look at their three different segments. That'll lead us right into the big mystery here, why the market's reaction was so quiet. And finally, we'll wrap up with our take on what's next. All right, let's get into it. The snapshot of RLI's third quarter really boils down to this one simple theme: amazing profits, but pretty lackluster growth. So take a look at this scorecard. It pretty much tells you everything you need to know. The top half, it's all fantastic news. Operating EPS, like we said, a huge beat. The combined ratio, we'll get into that more in a sec, but 85.1 is just stellar. And then look at book value per share, basically the company's net worth, up 26% year to date. I mean, those are just incredible numbers. But then you get to that last line. Top line growth, flat. And that's the real tension here. It's not just a mixed bag. It's a clear signal that the company is choosing profitability over growth, and that choice, well, it explains almost everything. So, how on earth did RLI manage to print such big profit numbers without really growing the business? Well, the answer lies in their core strength, and that is just exceptional underwriting discipline. Let's dig in. Now, before we go further, let's quickly touch on this term, the combined ratio. It's probably the most important number for an insurance company. Think of it this way. It's what they pay out in claims and expenses divided by what they bring in from premiums. So if that number is under 100, they're making a profit just from writing insurance policies. Simple as that. And RLI's number was 85.1. Look, anything under 100 is good. But getting down into the mid-80s, that is absolutely elite. That's best-in-class stuff. And what's more, it's a huge improvement from 89.6 this time last year. This number, right here, is the engine that drove that huge earnings beat we were talking about. Now, a result this good doesn't just happen by accident. It really came down to three things. First, they got a little help from Mother Nature, a quiet catastrophe season. Second, their investment portfolio did really, really well, kicking in over $41 million. And third, and this one's really interesting, they had what's called favorable reserve development. It's basically like finding money in the couch cushions. They had set aside money for old claims. Those claims ended up costing less than they thought, so they could add that cash, almost $14 million, straight back to the profit line. And this quote from the CEO, Craig Cleethermees, really sums up their entire game plan. He basically said, look, we're happy to grow when the timing is right, but when markets get soft and competitive, we are dedicated to discipline. He's not apologizing for the flat growth. He's telling you it's a deliberate part of their strategy. It's a clear message: we care more about the quality of our profits than the quantity of our growth.
Okay, so let's peel back another layer and look at the company's three main business segments, because you'll see the story is pretty different depending on where you look.
And wow, this chart just lays it out so clearly. Just look at that property segment on the left, a combined ratio of 60.2. That is just an unbelievably profitable business. Surety in the middle, also looking really solid. But then you get to casualty on the right at 98.2. I mean, they're just squeaking by, barely profitable. So you can see, almost all of the company's underwriting profit is coming from one place. And here's the other side of that story. That super profitable property segment, its premiums actually shrank by 11%. Why? Because management saw the market getting too competitive, so they pulled back. And where did they grow? In the casualty segment, which is just barely breaking even. It grew by 8%. This is that discipline we were talking about in action. They are literally steering the ship away from easy growth and toward the best profits. Okay, so this all leads us to the big question, the central puzzle of this whole earnings report. You've got this massive earnings beat, incredible profitability. You'd think the stock would take off like a rocket, right? Well, it didn't. The stock's reaction to all that fantastic news was a 2.8% pop. I mean, sure, up is better than down, but for what looked like a complete blowout quarter, that's a pretty lukewarm reception, to say the least. So yeah, what gives? Why the hesitation from the market? And it really comes down to this classic Wall Street tug of war, the bull case versus the bear case. The bulls are looking at the here and now, and you can't blame them. A massive EPS beat, that incredible combined ratio, book value is way up. They're saying this company is executing perfectly. But the bears? They're looking ahead. They see that flat revenue growth, they see a stock that was already down big for the year coming into this report, and they see a property market that's getting tougher. So the market is basically caught. It's celebrating today's amazing profits, but it's really, really worried about tomorrow's growth. So, where do we land in that debate? Well, let's get to our official take in our final segment, the next call. All right, here's our thinking. For the fourth quarter, we expect to see more of the same. Management is going to keep protecting those profit margins, even if it means that top-line growth stays sluggish because of that competitive property market. So what does that mean for the stock? We think it's probably going to be stuck in a range, trading near its lows. The market is just waiting for some kind of catalyst, some sign that the property cycle is turning and growth can come back. Which brings us to our final rating. We're calling this a market perform. Look, the company is executing flawlessly. They're doing everything right. But the headwinds in their main sector are just too strong to really see big upside in the near term. It's the classic story of a great company in a tough environment. And as always, a quick reminder, this is not financial advice.